Oh man, so we've just received the September CPI reading and it's come in a little hotter than expected, but the market seems to be shrugging it off. Let's take a look at the report which has literally just come out and let's take a look at the broader market. So we can see the report has just come in and September's inflation figure month on month was 0.4%. Now the consensus was 0.3, so slightly higher than consensus and slightly higher than August, where we thought we saw this turning point and things were starting to come down. It has still increased, but it wasn't a crazy month, right? It wasn't a 0.6, a 0.8 or a 0.9, and I think that is why the market is taking this in a positive way. Now, excluding the volatile food and energy categories, CPI was up 0.2, okay, and that was about the same as consensus, 0.2, and it was 0.1 in August, okay, so still slightly up again, but not as high as people had feared. Okay, so let's take a look at the year-on-year figures, and you can see they've come in at 5.4%, okay, versus 5.3% in August. So that's your year-on-year figure. And like we said yesterday in the video precluding this, this is going to be a discussion around whether we were getting the tip down or, which is what we can see now, we're starting to get a little bit of a ramping up, right? We didn't get the cooling off that we were expecting. Having said that, the reason the market is taking this positively is it's not a massive climb up here, right? It's almost a leveling off versus a climb, as you can see here. So that is one of the reasons we're seeing that. Now, let's take a look at the report and let's see where we're seeing the biggest jumps in the reading. So let's see. So we can see... obviously, you've got massive bumps up in food and energy. You can see 24% on there, 41% on there. You got 42% on fuel oil, 20% on utilities, 24% on used cars and trucks. So that's gone straight back up. That's a big uplift again. And we saw that on the Mannheim index. If you watched my videos yesterday, we predicted that on the Mannheim index. Now let's carry on. Let's see some other outside of energy and food. Let's have a look at some of these other categories. So let's flick down here and see which ones have moved massively. So again, 6.4%. So airline fares have actually gone down 6.4%. Very interesting, because that's an important part of the reopening play. And the fact that airline fares have gone down 6.4%, that's a positive sentiment, and markets will take to that pretty well. Let's see what else has moved. 3.1% on crackers and bread, so no buying crackers and bread anymore, guys. 5% on uncooked beef. You got to buy cooked beef, guys. I've been telling you from the start. 3.8% on frankfurters. For those after frankfurters, they're now out of reach. 3.8% inflation on apples. What else has moved big? Not many big movers here. 3.7% other fats. No, I was expecting, look, 10% down. What's that called off? 10% food at school and food at employers. Okay, so it's now cheaper to buy food at your workplace or school if you're at school. Interesting. Okay, there you go. 8% other linens. Other linens. There you go. 8% up on other linens. Let's keep taking a look. What else has caused some of this climb? Nothing major here, guys. Nothing major here. 3% down. What's computer software has gone 3.5% down. That's good. What else has gone up? What else has gone up? Nope, 0.7, 6.4% down on airline fares. Yep, we've covered that. 5% down on public transportation. Yep, we've covered that. So there you go, guys. But pretty much, that's very interesting. We'll do a deeper look on this later on, but that gives you an idea that it's some of the more transitory things which are up at the moment. None of the core, really important stuff are up right now. I mean, the used car prices, of course, we saw that was up, but we've known that's been an issue for a while, partly due to chip manufacturing as well. And then obviously the airline fares coming down was interesting. Postage, nope, fairly flat. Okay, interesting. And then obviously your if we come back up to the top, you'll see the biggest increases are in these items here, right? So you're looking at your unadjusted position on your energy, your fuel, your used cars and trucks, new vehicles 8.7, commodities 7.3. So there you go, guys. So let's take a look at how the SPY is responding to this. So first, let's do Bitcoin first since it's open. So you can see Bitcoin has pretty much shrugged this off. It's not fallen massively. We had this candle down here, which is not massive, and then it's kind of moved sideways. So not a massive move on Bitcoin. And again, this is, remember, if inflation comes in really hot, Bitcoin should theoretically climb. It's not coming super cool, so Bitcoin won't fall. We're still in an inflationary environment. So that makes sense why Bitcoin is kind of still moving sideways and doing its own thing right now. Let's take a look at the SPY, which is the S&P index. And we can see the SPY pretty much just shrugged this off as well. A little bit of a fall here. But pretty much, nope, it's taking it in its stride. It's shrugging it off. And again, because the is so close to the forecast, the market isn't too worried right now. You didn't see any massive selling or anything going on here. And it's looking pretty okay. Let's look at the volatility index, which is the VIX. You can see the volatility index has fallen as well. Okay, so on the last hours, we can see here, volatility index has from here we can see it's dropped. Okay, so we had a nice drop in volatility, which is quite good. Market's not too concerned, taking it in its stride. They were expecting probably a worse figure than this, so that's a good indication that we're seeing this. Let's look at the 10-year treasury. That's always a good indicator. Let's look at it. Yep, that's fallen down to 1.57. Okay, that's falling quite a lot, guys. Let's look at the daily range. And remember, your treasuries will go up in a higher persistent inflationary environment. So this is making people feel like that their coupons are worth more because we're getting less inflation than expected. Therefore, your prices of bonds go up and your yields come down. I know it's a bit complicated, but that they move inversely, okay? So the yield is going down, which means more people are buying bonds. We can see that fall right here. I mean, we're sitting here at the peak of 1.6, and now we're sitting here at a 1.569. So this should translate across into a good day for growth stocks. However, we know the market can take time digesting this data. So they may be acting with euphoria right now because the inflation figure wasn't as high as expected, but don't be surprised if the market halfway through the day just digesting, oh, hang on a second, used car prices are still up 24%, energy crisis is still there, fuel is still up, and maybe they get the jitters halfway through the day and we maybe see yields start going up and a rotation out of growth stocks. We've got to keep an eye on that because the market can take time to digest it. But for now, on the surface of it, it's a decent inflation report. I mean, we were having worries at one point that this was really going to go back up and maybe see a 6%, a 5.8, 5.9% year-on-year inflation. 5.4 isn't the downtrend we wanted, but it also mitigates some of the concerns we were having to the upside. Now, coming back to the more important thing, the elephant in the room is the discussion around tapering. And will Jerome Powell now use this as his reason to start tapering? We know the Fed convene on the 2nd and 3rd of November, and I think the inflation goal has been met, right? And this hasn't really changed that for the Fed. The Fed can tick that off and the inflation job is met. And now it will come down to their interpretation of the weak jobs figure that we've seen. Okay, so they've got all the data they're going to get now. This is the last catalyst going into that meeting for Jerome Powell. He's got a weak jobs figure. His inflation is fairly under control to the level he's expecting. And I think I don't think that's going to change his plans around tapering now. I think he's going to go ahead, pull the trigger, and we could see an announcement in November of tapering to begin in November itself or December, and probably an equally spread taper. So that's what the other thing we want to listen out to is how aggressively does he taper? Will he taper faster in the first quarter? So we're pretty much done by Q1 2022 and just a little bit left in Q2, or does he do an even taper, gradually doing that in a linear manner? That's what we need to look out for. Okay, so we can see here, the VIX plummeted. We can see the SPY not shrugging it off, crypto shrugging it off, not really bothered. It didn't move either way. And we'll see when the market opens. Let's just take a quick look at pre-market. Yep, so as we can see, we're kind of edging green now on the pre-market. I think let's take a look at S&P futures, 0.12 on the S&P, flat on the Dow, and 0.4 on NASDAQ. Again, makes sense, slightly green on growth, but not super high, not massively green because we didn't get a massive fall in inflation. We're still in an inflationary environment, but it just wasn't as high as the market expected, so they can edge a bit green. And that's pretty much what we're seeing here in the pre-market figures as well. We got some of the solar plays still doing well. Twilio up, Netflix up. We can see Matterport up another 0.8, Snap, Enphase is up 0.7, and it's just a good time to be in the market, really. I think the market has decided that they want to invest. They're not going to rotate out. We've gotten through a lot of the FUD and the worries around the market this month. I mean, September and October was a really volatile month. I mean, we had the Evergrande crisis, we had the government shutdown, we had the debt ceiling, we had Delta concerns, we had the jobs figure, we've got now CPI, and the fact that we've managed to navigate that in an effective manner, and the prices are still good prices. I mean, you got to remember, Tesla is over 800 right now. Enphase is sitting at 172. You've got Snapchat high 75, 76. You've got Matterport close to 20. You've got Nvidia at 208. Twilio still sitting at 320. You've got Netflix at 630. Solar Edge at 303. I mean, everything is doing pretty well. Google sitting at 2748. You've got Facebook 326, despite what's going on with them. The market is in a good place. I mean, these are not the lows we were seeing earlier in the year, and the market is really showing signs of strength, shrugging off all of these catalysts, which in an alternative world would, you know, really shudder the market. But we barely got a 5% correction, and the market's moving from strength to strength. I think now's a great time to still have your money in the markets. Like I said from the outset, when people were rotating away from growth stocks, I sat in those firmly, because now when you're seeing what's going on and you're going to see the tapering come and go, you've seen inflation come and go, and people start to understand and grasp that, then the rotation is going to come back out of these low risk stocks into your growth stocks as investors and institutions seek yield, right? They're going to want yield. They're not going to sit on their their value stocks for too long, right? It's not going to give them the returns that them or their clients want. So ultimately, we're going to see that once some of these fears dissipate, and we're pretty much there now. We just need to see the start of tapering. Hopefully Jerome Powell doesn't throw a spanner in the works. He just announces it. We get it over and done with. We make some meaningful progress towards tapering. Everybody can understand, okay, this is not too much of a big deal. We can cope with this. We can manage. We don't need to have a taper tantrum. And then we can go away on our recovery. Don't forget, October's another month for earnings as well. We're going to get a whole bunch of earnings. JPM have provided their earnings already. They had a beat on revenue and a beat on earnings, which has shown a really good strength. You're going to get a whole bunch of other banks giving earnings over the next kind of 48 hours or so and going into this earnings season. Okay, so we're going to get the banks first. Then we can look at some of the retail companies. It'll be good to understand, you know, what kind of supply chain shortages are there and what kind of timelines do we expect these to be there for, to be present for. Okay, so we need to listen out for those anecdotes from the earnings calls, and ultimately my position stays the same. I'm still you saw me buying the dip when we had that 5% correction. I'm happy with my positions in a lot of these growth stocks. If we get another dip anytime in the future, I'll continue to buy them because I'm buying into stocks which I have high conviction for, and I believe in those in the long run. There you go, guys. If you like my perspective, then please don't forget to hit the like button and subscribe, and I'll see you in the next one.